Hi, good morning, and welcome to Capital Grounds Podcast. I'm your co-host, Nick Miller. Got my other co-host, Joe Fisher here. We're with SITG Capital, a real estate investment firm based out of Texas. We've got properties in Dallas, Austin, Houston, looking to expand across the Sun Belt up the I-35 corridor. Right now, we view the current market environment as a time to take action and make some great buys. But this
hmm
morning, we're bringing you real estate news, real estate topics, a little bit my favorite part of coffee talk. And we've got a special guest with us, Fred Owens. He does residential and commercial mortgages. He's been a friend of ours for quite some time. Great business partner, great friend, great guy in general. So happy to have you, Fred. How are you this morning?
Doing well. Appreciate you inviting me on and excited to have a great coffee grounds conversation with you guys.
Yeah, thanks for being here. Joe, how are you this morning?
Hey, doing good. It's hot out here. Hotter where Fred's at over in Phoenix, but we're feeling it all across the states right now. So besides that, things are good,
That's good. That's good. Yeah. Uh, Fred, I don't envy the weather in Phoenix, but hope you're staying cool. What are you sipping on
Yeah,
this morning? What kind of coffee you got in the cup?
I got some Colombian coffee, some of my favorite here. It is some coffee that we were able to receive when Joe and I were in Colombia
hmm
back for New Year's. So it's definitely my favorite coffee. And I have a special mug here. I actually stole this from my wife for today. She's a huge cow fan, so this is a shout out to her. She is on a work trip for the rest of the week, and so this is kind of my little shout out to her. I guess I'm trying to remember her as I'm keeping the house together by myself here. So
So with your wife gone, Fred, I guess we should all be surprised that you actually have coffee in your cup, that you could
hey,
actually make it yourself, man.
Keurig is a blessing, is all I'm
Yeah.
saying. It's great. No, we got those little pod things that you can add in your own coffee grounds to, or
hmm
just throw it in there. Oh my God, one of the best buys we've done in the last couple of years. So it's good stuff. And yeah, it's hot. It's been about 110 plus for like the last
Yeah.
almost 2 weeks. So
Oh
not
man.
spending too much time outside, but
Right.
still it's still pretty nice being out here though.
Man, I'll tell
That's
you guys,
brutal.
with the heat like it is right now down in Texas and Phoenix, I mean, we're not quite that bad, Fred, but we're pretty bad. We have triple digit days pretty much every day. But, you know, I will say that iced coffee does hit a little bit different right now. Uh, so I've been going down to the shop at the corner, Full City Roosters, getting iced coffee from there. Man, you have that in the morning when it's, 80 plus degrees outside, going for your morning walk. That's kind of a different take that I don't mind in the summer on coffee.
Fair
No, it
enough.
actually sounds amazing right now.
Yeah.
Iced coffee outside and the heat. I don't know. It might melt pretty quick in this Arizona 115-degree heat, but you know, we'll try that at a later time.
Joe, you mentioned in a previous episode
Yeah.
Topo Chico ice blended coffee. Is that
Yeah,
right?
he's yeah, Michael, the guy that owns Full City Rooster, he's got a Topo Chico cold brew that he
Hmm.
does. Now I haven't had it yet.
Still,
I'm a
okay.
little afraid to try it. I'll probably wait till you come down here, Nick. We can try it together because, I gotta
Okay.
gotta venture out a little bit. But man, when you're craving that one thing in the morning, you go down there and you get it. That's starts your day off right.
Hits the spot. I love it. I love it.
Yeah. What you got today, Nick?
Yeah, so I've got my Wyoming mug mentioned previously. When I get a new mug, I like to, you know, work it out for a few weeks. I've got a pretty standard blend in here this morning. It's a Wide Awake Coffee Company. They're a national brand. They're pretty big. They've got a
hmm
breakfast blend. It's I don't know if I would call it a staple, but it's an easy win. You know what to expect. It's not going to surprise you in either direction. It's
Sure.
pretty dependable. So something simple. I ran out of filters for my pour over, so just trying to make things a little easier this morning on me. But yeah, what
Wait, is your
Joe?
wife gone too, Nick? Why are you trying to make things easier?
She is at work. She is at work.
Oh,
So,
okay. Okay, fair
might as
enough.
well be gone. Might as well be gone. But man, so tell me, Joe, any interesting news lately?
I mean, there is, yeah. I mean, we've been talking about this heat going on in the literal sense, summer heat, but there's a lot of heat in the real estate markets too. I don't know if you guys follow the real deal, but there's a lot of articles coming out about, some different crowdfunding sources that have basically done really bad. There's a um, article today that Nightingale uh, basically they're getting accused of taking tens of millions that was earmarked for a property in Atlanta
Hmm,
and misappropriating those funds somewhere else. So I think this is the time, and you're seeing it in the news a lot, where you could get by the last 5 years, maybe even more. I mean, I'm open to opinions from you guys on that. By being a bad operator, by not doing things appropriately, things like that, you could probably get by just because everything was working in your favor. But
sure.
now that nothing is working in your favor, rates aren't working in your favor, rents aren't increasing anymore. Another article about Austin, rents have actually come down some because there's more supply hitting the market than there is demand at this moment in time. Now, long term, that'll shake out, right? But I think a lot of people are getting exposed right now. So you're seeing an article almost every day about somebody else that is in a similar situation, and they're scrambling, trying to figure out how to right the ship. And we think that, there's going to be a good number of these that aren't going to be able to right the ship when it's all said and done.
And
Yeah.
I see. So this is a personal opinion, obviously, but
Mhm.
I can see more regulation coming down the pipeline here in
Sure.
the next 5 years, especially if this
Yeah.
turns out very poorly. I can see more oversight requirements. I can see more, more restrictions on who can invest and how you can
Hmm.
invest. I think we're going to see a lot more of that, especially if this stuff keeps, if these, I'm not going to say bad actors, but if these inexperienced people, if we keep seeing mistakes coming out of the woodwork, I think it's going to
Yeah.
be
No, I
tough.
agree. I agree, Nick. And for me, I feel like myself and uh, our partners at our firm, we've seen that this was an issue for some time, but again, people weren't really getting exposed here. It's only recently that started to
Sure.
happen. So that's why we set up our firm the way we do. We're not really syndicators. Yes, we do raise money for projects and try to get people, our investors access to projects. But every deal we do, we put money in, and this is a big reason why is because when our money is in a deal, we're going to make sure that that deal works. Right now, of course, there's going to be variations in performance. That's with any investment, but we feel that that's the best way to protect our investors is by putting our own money alongside theirs and saying we're in this with you. But you see a lot of people that we're just going to CrowdStreet, funding their deals from there and not putting any money in and actually taking a cut of that off the top. So they didn't have any skin in the game, and so their actions were their actions are tied to something different than like we talked about, making sure that you have some of your own personal money invested into those projects.
Yeah. I'd be interested.
SITG,
SITG, skin in the game, right?
getting in the
Um,
game. Yep.
I'm I'm interested to see as we're approaching upon third quarter. I've got actually a couple
Mm-hmm.
of investing companies that I'm waiting to hear their third quarter earnings report. So that's going to
Sure.
be interesting to see what their outlook is and actually how they performed. I know a lot of people and other investors, those are some things that they look out for to get kind of an inside view on actually what's going on with some of these mostly I follow multifamily and
Right.
manufactured housing and some offices, but it definitely gives a good view on what they're planning on doing in terms of pivoting, actually how they're performing, because some sectors, depending on where they're at and where they're heavily invested, are
Mhm.
doing somewhat okay, and some are not. And it's interesting, obviously, in Austin, to hear as booming as they are, that rents are starting to come down. It's kind of following the same trend that we have here in Phoenix. Obviously, in a
Yeah.
way, rents are still rising, but the percentage that they were increasing is starting to decrease. So
Right.
for some people, it's not like, oh, okay, now I've waited long enough. Now that rent for that downtown apartment is now going to be, instead of 2,500 or 3,500 bucks, now it's going to go down to 2,000. No, that's not going to probably happen, but it won't increase as fast as it was. So think we'll still see, to an extent, rents
Mhm.
being a little bit higher than they should, but we'll see. It's going to be interesting to see what third quarter does, and I'm interested in listening in on some of those
Yeah.
earnings calls, and seeing what
So
those companies are doing.
you bring up a good point, Fred, and I'd actually just for one of our large investors, he sent me something to take a look at, that he was looking at another investment. And I think this goes to what you're doing in your underwriting, right? Right now, there's still some people out here trying to write in double-digit rent growth. It's not happening.
Mm-hmm. Mm-hmm.
There's maybe one or two markets in the US where that might happen, and it's an anomaly, right? We are not in the same environment we were. There's not going to be double
Definitely
digit
not.
rent growth. There might be, we're going to, it'll stabilize eventually and get back to where we have been historically average. So, if you're writing right now more than 3% rent growth, depending on the market, obviously you're probably not really doing your due diligence.
Yeah, and that's a great topic that I think we're going to discuss here a little further, is,
Mm-hmm.
is some of those underwriting parameters, because
Yeah.
look, as doing the loans, and you're trusting that as a loan officer, we're also going behind you and doing that due diligence to make sure, hey, you're not going to get to in the middle of the process and be surprised by anything. Obviously, you want to discuss those things up front. But you can come in on your pro forma and say, oh, yeah, this is what I think it's going to be. But ultimately, and this is even on the lender standpoint, on the client and lender standpoint, it's going to come down to what that underwriter is truly seeing once they do the digging on
Mm-hmm.
the market. This is what they're projecting.
Sure.
Because in most lending cases, unless you're doing some serious hard money or private money to where they're just really not caring and they love the area and they truly think that, hey, what they're going to get is what they're going to get, and they really don't care about what a licensed appraiser is going to say. They're going to go off of what they're expecting based off of the current trends. So if you're not taking that into account, you're probably going to have a surprise at the end to where you're going to have to bring more capital, or you're going to have to renegotiate at the end, which is never
Right.
a good idea.
Or to me,
Yeah.
in a lot of instances, it's kind of in bad faith that you're showing, some of these numbers when that's not the reality, right? You're trying to raise the money to do the deal. And when you come out with, like Fred mentioned, we're going to talk about it here, but when you come to the lending port, or you're going to have to go back to investors and raise more money just to get that deal off the ground, just to get, lenders to give you the money that you need, to be able to move that deal forward. So I think you got to be careful there. You got to know what you're doing. And we'll talk a little bit more about that, but Fred, where are we at right now, just on rates, kind of in general, just to kind of update everybody. I don't think we've talked about it recently. So where are rates at for us?
Rates are a range, depending on the scenario, but rates are
Sure.
probably ranging around. Actually, just checked it not too long ago. It's about around a 5.5%. I'm specifically talking about commercial right now, around a
Mm-hmm.
5.5 up to about a 6.5% on most permanent debt rates.
Sure.
Obviously, if you're looking at something like a bridge loan or construction loan, it's going to be a little bit higher than that. You're probably looking at something around maybe the 10 to 12%, depending on the scenario and the
Yeah.
profit margin on the exit strategy on that. But yeah,
Mm-hmm.
on standard debt, you're probably looking around 5.5 on the low end to maybe up to 6.5 on the higher end. Oddly enough, residential is pretty much around that same range. You're getting 5.5, mostly on things like a 15-year. If you're good credit, good scenario, single family home, non-condo, non-investment, you're looking at something around a 5.5% for a 15-year. Up to 30 years. 30 years are around this mid to low sixes. So, pretty standard there. Inflation's going down. I don't want to do too much Fed talk because I know, anytime you turn on the news on any financial, they're hitting you up with Fed talk. But inflation inflation is definitely trailing down, and I know the Fed is expected to continue either raising rates 1 to 2 more times and getting it around that 2 to maybe in that mid to high 2 range for inflation. So you're probably going to see rates stay a little bit higher where they're at right now for a little while, but who knows? Maybe they might show that cut at some point in the next year or two. So
I mean, I don't know. We'll see. I don't know about a cut, but I am. I mean, a lot of people have been pricing in another hike in July, but the Fed really doesn't have much of a history, if any at all, of pausing rate hikes and then starting them again. So I'm just curious to see, now that we have had more positive inflation reports, if maybe they just kind of, pause and see what happens here for a longer period of time. But nothing we can do but speculate, to your point, Fred. So, probably not worth much of our time. So
yeah, exactly. and I always find it interesting when you're following some financial media outlets, and it seems like over these last few years where the Fed's all been mainstream on everything there, everyone is right at some point. They're all like, oh, I think the Fed's, going to cut. And the people who are wrong about it, you just don't hear about them for about 3 months until something changes. And they're like, oh, you were right 6 months ago about when it's like, what?
I mean, that was always my problem with CNBC, right? They'd always predict 12 of the last 4 recessions, or whatever the saying is, right? They always say, oh man, it's bad, it's coming, it's bad, it's coming, it's going to be here. And then finally, when it happens, even if they were saying it 2 years earlier, oh yeah, I was right. But you can't predict the future, man. You can't.
If you just right now go and say, you know what, I think, and full disclosure, I'm not saying this will happen. Obviously, if as you can tell, I'm not making any predictions on it. But if you go out and you say, oh yeah, I think the Fed is gonna cut rates on the next one, and for some whatever reason they do, oh, you're a genius. It's just interesting how, and then, oh, you knew all along. It's like, no, you didn't. You're just guessing. But anyway, I digress on that. That's another podcast conversation.
You say tomorrow is Monday. Enough times, eventually you're going to be right.
That's right. Exactly. That's right.
Yeah. Well, Fred, I appreciate you being here. Thanks for talking us through this stuff. We've talked, you and I and the group of us have talked a number of different topics when it comes to things that we can do to prepare appropriately before submitting a proposal to a lender. You've made a number of great points, which is why you're here today, right? But first off, I want to hit on the rent schedule comments that you've made in the past. Having a rent schedule pre-built. Tell us more information. Tell us, what that means, why it's valuable, and how to go about doing that for our viewers.
Absolutely. So this is actually something a good buddy of mine, and hopefully one day we can maybe get him on your podcast. He is a licensed commercial appraiser. He is actually out here in Arizona, but some of the licensing practices are pretty universal. So a lot of that is, some of it is state by state, but there are a lot of practices that are universal. And we've been doing some deals with you guys. And sometimes, as we're going through some of these, we're always trying to get better at how we can avoid pitfalls. And one of the pitfalls that even in the residential realm that you can run into is when that appraisal comes around, you're kind of almost crossing your fingers and hoping that, okay, hopefully we get what we're expecting on the rents. The expenses were around range of what we're expecting as well. So, when we sit back and after we complete a deal, we're always thinking, okay, how can we make sure that we can better the process, make sure, hey, there's no, we can make the process as smooth as possible. And one of the ways when sitting down with him is, when you're doing a new construction, multifamily or office or what so have it, you want to understand what those rent projections would be. Now, right now, if you don't have access to a lot of the databases, you're probably looking at something like Zillow. You're just looking at, what rents are going on Zillow or Realtor.com or even Apartments.com, and you're doing your best estimate, or even things like CoStar. We use CoStar as well to try to get our best estimates of what rents should be and what the increases might be, things like that. But you ultimately, when an appraiser gets in front of it and they do the comparisons on rents of like properties that are local to that property you're either developing or purchasing, that can change things. And depending on how tight you already are on your profit margins or exit strategy, incisors, that can sometimes kill a deal. So it's great if you can spend a little bit of money up front and get a licensed commercial appraiser. These are specifically for commercial deals I'm speaking on, to do a rent schedule first, because that's gonna help save a lot of the headaches. So that was something that I find is almost invaluable at this point. It's like, hey, if you're going to do one of these deals, spend the maybe $1,000 to $2,000. Just go ahead and add that into your budget, so that not only can you have a good plan and kind of evidence of what you should be getting, but if there is a difference in your appraisal, let's say you do the rent schedules with the license appraisal, and for whatever reason, the appraisal that you order or that the lender orders for you comes in a little bit different, you have evidence to claim for a revision of value on that one. Because ultimately, it's the same thing in residential. You look at a piece of property, you're like, oh, well, I think I can get $3,000 a month off of this unit. Look, and you have all of your reasons of why, but unless you can prove it, that's not what you're going to get. And the best way to prove that is if you have an independent appraiser indicate that, yes, this is what you should get. So that was something we came across, and I thought it was a great idea. Like I said, we're always trying to find ways to improve and avoid any type of pitfalls. So that was something that, when he was talking to me about that, I was like, man, we got to do that, especially if the cost on a multi-unit, multi-million-dollar property, you're talking about an extra, couple grand to avoid maybe having to bring $1 million to $2 million to and an additional down payment if your NOI doesn't come in, where it's supposed to. So I'd love to hear you guys' take on that as well as we're going through that.
And avoid delays. Yeah, go ahead.
Yeah, I was going to say that too, Nick. I mean, you bring up a good point, because Fred and I had one where we got delayed because of this exact reason here, and so we're taking a more proactive approach at this point. Even with our construction loan that we're working on right now, we're about to break ground on an apartment complex, and we're going through that process. So, this is something that I think just needs to get worked into the due diligence process at the beginning, because to Fred's point, you can get some of this data, but you don't know what the appraiser is going to say, and they're not going to change it based off of your word. So you need to have something else there that says, hey, it makes sense for you to change this. Here's the evidence I got. And to Fred's point, if you've got a licensed appraiser that says this is the finding I have, they're much, much more likely to change those numbers for you and make that a more favorable outcome. And then, you're ultimately bringing less to the table, which means that you're getting that deal done versus, maybe having to go back and raise additional funds to try to get there.
Yeah.
And having that I was going to say, having that, can also reconfirm your expectations for the performance of the property, right? It's not, I mean, obviously it's great to have it for the bank, but there's a lot that you get out of it as well.
Absolutely. And that's actually what I was going to kind of touch upon as well. And for the bank, that helps out. As a lender, if you come with, when we're looking at, getting your deals, and I'm a commercial broker, so we're brokering out some of those deals. If you have a rent comparison or rent schedule for your properties that we can also include in the loan package, that helps out because lenders are going to do their own, good lenders, they're going to do their own underwriting and kind of source what they think the rent schedules are going to be. And in some cases, they can challenge those. And like, okay, hey, this is what we're thinking in that area the rents are going to be. So this is what we're expecting the net operating income ultimately to be at, and this is what we'll end up to. And we can touch on sizers in a second if you want. But when they do that, that can change things. But if you come and say, hey, we've already done rent schedules on these units, and as a licensed appraiser independent that we've done these on, and this is what we're showing, and this is what they're showing, you're going to get a lot less pushback because
Right.
everyone's guessing. No lender is out paying for that up front for every deal that they see. They're doing the same thing. They're going to CoStar, or they're using their own, if they're a local lender or credit union, they're using their own kind of knowledge base of the area and trying to see maybe past deals that they've done recently on that. But they're in the same boat. Ultimately, it's going to come down to what that licensed appraiser is going to be like, okay, hey, because they have better data than anyone. They have kind of their commercial MLS that they can go to that's already pulling in all those numbers. So if you can get access to it, and you got to pay for it, on each of the deals, but I would just build that into your due diligence because it's well worth it, especially if you're partnering on deals. You never want to get to the fact of call and say, hey, appraisal came in a little light. Now the lender's only doing this, so we're going to have to bring in an extra $500,000, which obviously it's still equity you're putting into it, but
Sure.
if you could have paid $2,000 up front and been like, and avoided that or readjusted, as you said, readjusted your expectations, that can help a lot of headache in the, it'll help you avoid a lot of headache in the future.
Definitely. Well, and I'm assuming, Fred, anything you can do on your side is a positive thing with how much tightening that's going on. So, if you're the better prepared you are in these situations, the more likely the lender will be to work with you on a potential loan.
Absolutely.
Well, and what I hear you say, Fred, and I think this is a good segue into my next question, my next comment for you. If you put yourself in the lender's chair, if you will, or in the boots of the lender, they're looking at any deal. They're looking at any deal from a worst case scenario, and they're saying, okay, if we had to repossess this property, if we had to go back and we had to take this property on ourselves, what are the numbers that we would expect? And what could we realistically get out of it if we were to sell it from somebody else? And you've mentioned in the past that when you are making your projections, you're plugging in your expenses, you're estimating some of these costs or the performance of some of these areas, that you should be doing it from the perspective of a third party because that's what the bank's going to be lending at. Can you speak a bit more to that?
Yeah, absolutely. And, full disclosure, I'm not a licensed appraiser. And like I said, I think it's going to be great. We'll hopefully get one on here, my buddy. If be willing to get on here. But these are some of the things that he shared with me. Like I said, doing due diligence and expanding your knowledge base, just having those conversations. And it's funny enough, on one of the deals that I've worked with you guys, this was something that we were looking at and adjusting was on those expenses. There are some expenses that appraisers, come to find out, have as a standard expense. They have things that they do comparisons even on expenses like they do rents. They do the expenses comparisons with local and properties. So if they're comparing it against maybe 2 or 3 other properties that are like yours, and all of those properties have these same recurring expenses, they're going to bake that in, even if you don't have that same expense. Perfect example is, there are owner operators that are planning on operating their own properties when they acquire them or build them. And they might think to themselves, well, you know what? I'm going to get everyone word of mouth. I'm going to go myself and go downtown. I'm going to use megaphone and shout out all the advertising that I'm going to do for this property. So, they're, my advertising budget should be 0. I'm going to just do it myself. It doesn't work like that. because
Right.
everyone else, all the other properties are averaging on their advertising budgets, let's say $4,000 a year. So the appraiser is going to utilize a standard number for that advertising budget because, to their mind, like you said, Nick, as a third party, they have to think of it. Not only the appraiser, but even the lender thinks of it this way. That's why that works. Is if someone else had to come in as an operator, what would they charge to get this building up to snuff? And obviously, this is a great segue from the past comment Joe said about some of the operators that are getting in trouble. There are some deals where lenders will come in and for their stipulations on either extending a deal if you got in trouble or not calling a loan due might be to change the operator. Because if the property is not performing, and let's say they're when you got into the deal and got your loan initially, it was based off of, hey, you're going to get occupancy up to 90 to 95% by 12 months, and it's 12 months and you're only at 65. They're probably going to remove that operator. They'll probably require the operator to get moved and get a professional long-term operator in there. And when that operator comes in, they might look at those costs and be like, oh, but this is why the advertising budget's only $500. We need a higher advertising budgets and getting more people in on free rent or rent, or whatever they do to get it up. So those are some things that, and that's just one aspect. You got things, I think, Joe, you can speak on this. Excuse me. You can speak on this. We just finished that development of some townhomes, and HOA.
HOA, man. Yeah.
HOA was a problem because it was, hey, we're not planning on having any HOA, or the HOA is going to be pretty low, and we were getting hit for a higher than what we thought would be the HOA, but it was because it was compared against some of the other like properties that were condos and they were charging what so had before it. So.
Right. I think that's a good illustration for, a third party. I mean, I liked your advertisement one too, Fred, but HOA, yeah, I mean, we own the whole complex. So obviously we're not going to charge ourselves an HOA fee. That makes no sense, right? But they're looking at it again from the perspective of, okay, if we have to take this property over, what's going to happen? Okay, we have individual units we can divide off or sell off. How do you maintain the property at that point? You have an HOA, right? So that's how they're looking at it. Now, I think, in my opinion, there should be a little bit more room on that, and probably to Fred's point earlier, make sure you set it up the right way going into it. Which it wasn't. I'm not going to blame anybody here. It wasn't entirely our fault on that and how that kind of got set up going into it. So, but I think I agree with Fred. You got to look at it like a third party and make sure that, you're accounting for some of those things that you're not really expecting to account for.
Yeah. And to that point, and just like in residential appraisals, you can challenge anything on there.
Yeah.
And we did on some of those, we challenged some things on it, and we're able to get some things reduced because they are going off of standard expenses. And you can come back and say, oh, this expense is not going to be the case there because we don't have this. So a lot of that can be challenged. So I don't want anyone to think that, oh, okay, whatever they put in as standard is what it is. No, that's not the case. But you have to be reasonable on some things, and I think, like you said, that advertisement is one that you're not getting away from that. Even if you really think, well, I know 1,000 people on Facebook and I'm just going to post it on Facebook and that's going to be my advertisement. You're not getting away from those standard costs of items like that. So.
Well, and look, here's the thing, Joe, Joe can attest to this, and I can attest for Joe that, when we do our due diligence, we're very, very particular about making sure that the numbers are representative of the actual market. And if you can do your due diligence from the perspective of a third party, it's a great stress test to make sure that the deal is still a good deal and one worth doing. Because at the end of the day, if you can add in some of these additional expenses, if you can really put your competitive edge to the test and the deal still makes sense, then when you actually execute, you're going to be able to outperform what your initial projections and expectations look like, because that you're able to do things for either a lower cost or more efficiently or what have you. But this only makes deals, I think personally, I think this is a great way to really make sure that a deal is worth doing.
Yeah, good point, Nick.
But Fred, you've used this term a couple of times in today's conversation, and would love it if you could give us a breakdown, a better definition of what exit sizers look like. What qualifies as an exit sizer, what the common exit sizers you use or see. Explain those to our viewers and give us an in-depth perspective on what it means to really understand those.
Yeah, great question. So exit sizers, I'd say that's commercial real estate terms for kind of the almost exit plan or ratios that you're going to need for obtaining that a lender is going to want to see to understand that you'll be able to get permanent debt and that the profit on the property that you're doing is going to be there's enough room there for the risk that they're taking on doing a loan. So a standard exit sizer, and those go in DSCR terms, which is debt service coverage ratio terms. It's about 1.2% is typically what a lender is going to see. Now, that does depend on the type of project you're looking at. Right now, for construction loans, obviously everyone knows construction loans in the commercial realm has almost completely dried up. There are some lenders that are still doing it, and I'm able to have connections with them, so we're able to source some of those deals. But a lot of the lenders that are still doing construction loans right now are requiring an exit sizer of a 1.3 DSCR. So basically, in layman's term, that's just meaning that they're wanting to see a 30% profit on top of the debt payment on the loans that they're going to do. So that is essential to know up front. And I think those, if we're looking at any core things to check out when you're on the due diligence side of doing a deal, number one, I'd say get that rent schedule, pay the money to do it. It's only going to be, depending who you're working with as an appraiser. Obviously, if they're a licensed commercial appraiser, you're probably looking at something around a couple $1,000, maybe $2,000-$3,000 at most to do those. So definitely do that, but also ask the lender up front, what are the exit sizes that you need for the underwriting on this deal? So that Now, why I put some emphasis on that is you might be getting a quote or looking at a deal for a lender, and they're telling you, for example, they'll do 85% loan to cost on your deal, or 80% loan to cost on your deal, where they're basically going up to 85% of the total cost that you're going to need to do in that deal. Looks great. Seems like a great option. You seem like, oh man, that's going to work out well for us. But if the exit strategy or sizer on it is a 1.3 or 1.45 DSCR on it, you might not qualify. And it's going to be a little bit more in depth to go into that. And maybe we can spend some time on going and how to calculate that out for a specific deal and how DSCRs, debt service coverage ratios, work. But a 1.4 in this market is going to be incredibly hard to do because rates are high. So you're already getting a lot of your income and a lot of potential profit eaten up by rates. And depending on if you've gotten a sweetheart of a deal, maybe you can make that work out. So it's important to know that, because if you don't know that up front, obviously, we won't go into this on detail, but Joe and I ran into an experience, I don't even know the proper way to put that. We had an experience with a certain situation to where, the debt service coverage ratio exit sizer wasn't fully aware or wasn't fully identified from one of the lenders we were working with. And it was very interesting because it caused a ton of problems. So you really need to know that up front. And if the lender or loan officer you're working with, or the company they're working with, if they don't understand that up front, that's a problem. They need to know that, because you're going to need to know that, because the underwriter is going to require that. And if it's something unreasonable, you don't want to have to go and get in the weeds of that deal and find out, oh, hey, sorry, I know that, we're trying to get you the 85% loan to cost, but now we can only do 65% because, we have an exit sizer of a 1.4 for DSCR. And you're like, well, crap, that's a lot more profit than, I'm needing to get the deal done. So anyway, hopefully that answered the question. I know that's
Yeah,
we probably need to
so
go a
I
little
think
bit
it can
more in
get a little
depth on that.
complicated.
Yeah.
I think it
Sure.
can get a little complicated. You got to just you got to be in this stuff to do it. And Fred's in it every day. I think sometime what we should do, guys, is we should get together and do a whiteboard session.
I was
Kind of
thinking the
draw
same
some of
thing.
these things out, get some visuals out there. Because when you're talking
Yeah,
about it, I'm like,
absolutely.
yeah, I'm following you, Fred, but man, it can get it gets a little confusing there. So
Yeah,
Well,
and honestly, it once you do it, and if I can explain it on a whiteboard, it's a lot easier. I think if we did a whiteboard session, it's a lot easier. And ultimately, if you're doing a deal like this, your mortgage broker or the loan officer can easily explain what this is.
yeah.
We do, and these options are in residential as well. If you're a residential, investor and you're doing single families, there are loans that are based off of solely, DSCR loans. It's very popular now, and it's
sure.
that same idea in commercial. It actually came from the commercial range, and now lenders have seen it now, and they're like, oh wow, this is a great option also for single family because the risk level there it makes sense. So it's now adopted its way into residential investing. So if you're needing
Yeah,
something
you're gonna
like
see it
that,
more.
you're going to see it a lot
Absolutely.
more, and we can do something on that, and I can write it out and show because it's really easy once you get it. You do it 3 times and you're a master at it. It's not anything complicated, but
Right.
hearing it is basic. It can be complicated because you're thinking, well, I thought if it was an 85% loan to cost loan that they were going to give me, I thought that that's what they were going to do. No, they're basing that off of back in parameters of what the property is going to produce. They'll basically, I will do this 85% loan to cost loan for you if you can prove after the property's been stabilized that it's going to produce a 30% profit is basically kind of what that is. And there's sizers that help you justify that up front. So hopefully that.
Yeah. Nick, write that down. Man. Let's do a whiteboard session. We'll write out DSCR, debt service coverage ratio, and then we'll go through and do everything so you guys can see it visually because even the acronyms, man, they get a little much. So
they do, yeah. Yeah, it's probably as clear as mud for some of our viewers that are just dipping their toes into the water.
Yeah.
But at the end of the day, and I think this is the key takeaway here from today's conversation, that all of these understanding all of these metrics, having all of this work done on the front end can help you close a deal quicker, can help you secure funding, can help you get the money borrowed that you need. And not having these things squared away beforehand can cost you time. Time is money, right? Can require a larger down payment, reducing your overall performance. At the end of the day, it's all going to go towards making a deal perform as best it can, right? You don't want to have any of these issues come up because sometimes it can cost you a deal or cost you more money. So yeah, I think a whiteboard session would be great. There are a number of topics that we could have a great session on. So maybe that's something we look at adding in.
Fred, I guess we'll have to have you back on, my man.
Absolutely. We'd love to do it. And I think just as an easy takeaway, I like keeping things simple. I know that last explanation, obviously that's in some in-depth things that you really got to know about, but to keep things simple, if we're looking at the biggest things that can go wrong or the biggest pitfalls that there's a lot of pitfalls that you can run into. Obviously that's in anything. There's a bunch of different unique scenarios that can come up, but if you're trying to avoid the majority of things that can kill a deal, you need to first off get a rent schedule because that can kill a deal if your rents come in lower than what you're expecting, or if your expenses come in higher than what you're expecting. Those two things, if you can do that up front, and if you can take one of those off the table by really getting an independent commercial appraiser to come on board initially and help you out with the rent schedule and give you just some peace of mind and some backup if you need to combat another appraiser that comes in. I think that's going to be absolutely amazing to do, and I think everyone should do that. But outside of that, those exit sizers, learning what the DSCR and what the exit sizers are, is going to be, I would say that's a close second, because if you can do those, you're going to avoid a lot of pitfalls, because you can calculate up based off of this rent schedule. Now you got the rent schedule in hand, so you know what the rent should be around. And if you can really provide a conservative third-party view number on your expenses, you know what your net operating income is. You can take the sizer from the exit DSCR sizer from that lender you're wanting to go with those best terms, and you can calculate out what you should be able to hit. And everything after that, obviously, if there's some unique scenario that comes up that you can't, plan for, that just happens. But you should be pretty confident that, you have the tools, you have what you need to have a smooth transaction with the lender, because those are really the bigger things.
These are really great tools to keep in your toolbox as you're going through this. And, Fred knows it inside and out because he's living and breathing lending every day. But as somebody who's putting deals together, you need to know this stuff inside and out too. So he's right. These are great tools to have in your toolbox.
Certainly. And knowing them before you need them, that's the key. That's the key, right? It's important to know what you don't know, so you can solve those variables as quickly as possible. But Fred, as always, great to have you on. I appreciate the time this morning. If you've got any questions for Fred, either shoot us an email, leave a comment, give us a call. Would love to connect you with him. He does commercial and residential mortgages again. If you're interested in some of the deals that we've got going on, some of the funds that we have available, we've got an income fund, pays 10% annually, pays out on a monthly basis. Happy to talk to you about any of the items that we've got and see how we can best work together. So shoot us a message. Give us a call, leave a comment. Would love to hear from you. But gentlemen, any final comments or thoughts for our viewers and listeners while we've got you this morning?
Thanks for the time, Fred. Really appreciate it, man. It's always good to have you on. If you guys haven't checked out our last episode with Fred, he tells you how you can buy smaller properties with no money. So go check that one out too if you're looking for a single family or a duplex to get yourself started, kind of like the three of us did. So take a look at that.
It's a great episode. Great episode.
Absolutely. Appreciate you guys. Appreciate you having me on.
Likewise. Joe, we'll look to talk to you again next week. And Fred,
Thanks,
we
Nick.
hope to have you on again soon. Thanks, gentlemen. Take care.